Hello, and welcome to this session from Aero Academy. In this session, we will discuss frequently asked questions on revenue from contracts with customers under IFRS 15, a standard that replaces all previous IFRS and US GAAP revenue requirements. Let us dive in. Successfully implementing IFRS 15 begins with a clear understanding of its objective. So, what exactly is the purpose of IFRS 15, revenue from contracts with customers? IFRS 15 was designed to provide the principles that a reporter shall apply in reporting useful information on its financial reports to show the nature, amount, timing, and uncertainties of revenue and cash flows that arise from contracts with customers. Achieving these objectives require a reporter to ensure that the revenue recognized in its financial statements depict the transfer of the promised goods or services to customers. The amount reported should therefore reflect what the entity expects as compensation for the promised goods or service. Is IFRS 15 applicable to all types of revenue contracts held with customers? No, while IFRS 15 applies to all revenue from contracts with customers, it does not apply to the following. Organizations or entities with financial instruments and other financial rights and obligations within the scope of IFRS 9, such as banks, will apply IFRS 9 financial instruments to account for interest income. Insurance companies and other institutions with contracts within the scope of IFRS 17 will apply IFRS 17 in accounting for revenue from insurance contracts, except for distinct and separable components of the contracts where applicable. Other scope exclusions include lease contracts within the scope of IFRS 16, IFRS 10, consolidated financial statements, IFRS 11, joint arrangements, and non-monetary exchanges between entities within the same business to facilitate sales. What are the key steps in recognizing revenue under IFRS 15? Well, the foundation of IFRS 15 is the five-step model for recognizing revenue. This model provides a structured approach to ensure that revenue is recognized accurately and consistently. The 5 steps are: identify the contract with the customer, identify the performance obligations within the contract, determine the transaction price, allocate the transaction price to the performance obligations, and finally, recognize revenue when the performance obligations are satisfied. These steps ensure that revenue reflects the transfer of goods or services and aligns with the value the entity expects to receive. How do you identify a contract under IFRS 15? The first step in the model is identifying a valid contract. A contract under IFRS 15 creates enforceable rights and obligations between the entity and the customer. Key considerations include ensuring the contract is approved by all parties, confirming that the collection of consideration is probable, identifying rights and payment terms, checking if the contract has commercial substance. A contract can be written, oral, or implied by customary business practices, but it must meet these criteria to be recognized. What are performance obligations, and how do you identify them? The second step involves identifying performance obligations, which are promises to transfer goods or services to a customer. These obligations can be distinct. The customer can benefit from the goods or service on its own or with other readily available resources. Non-distinct. These are combined with other obligations in the contract if they cannot be separately identified. It is crucial to carefully assess the nature of each obligation to ensure accurate revenue recognition. How is the transaction price determined under IFRS 15? The third step is determining the transaction price. This is the total amount the entity expects to receive in exchange for transferring goods or services to the customer. It includes fixed amounts, variable considerations, or any discounts, but must reflect the conditions agreed upon at the contract's inception. How do you allocate the transaction price to performance obligations? In the fourth step, the transaction price is allocated to each performance obligation. This is based on their relative standalone selling prices, the price the entity would charge if sold separately. Methods for estimating standalone prices may be required when no direct comparison exists. When is revenue recognized under IFRS 15? The fifth and final step is recognizing revenue. This occurs when performance obligations are satisfied, either over time the customer receives benefits as the entity performs, or at a point in time, when control of goods or services transfers to the customer. Determining the timing depends on whether the obligation is fulfilled progressively or upon a single event. When a performance obligation is satisfied over time, IFRS 15 requires entities to measure progress toward complete satisfaction. Two methods are provided. Output methods measure progress based on the value of goods or services delivered relative to the promised goods or services in the contract. Examples include milestones reached, units produced, or appraisals of results achieved. Input methods measure progress based on the effort applied relative to the total expected effort. Examples include costs incurred, labor hours worked, or resources consumed. The chosen method must reflect the actual progress and be applied consistently to similar performance obligations for accuracy and comparability. How are contract costs accounted for under IFRS 15? Contract costs are additional costs incurred to obtain or fulfill a contract, such as sales commissions. IFRS 15 allows these costs to be capitalized. If they are expected to be recoverable, these costs are recognized as an asset and reported separately in the financial statements. Amortized. The capitalized costs are systematically amortized in line with the fulfillment of the related performance obligations. Expensed. If the amortization period is less than 1 year, the costs can be expensed immediately as a practical expedient. Amortization may need to be updated if there's a significant change in the timing of transferring goods or services to the customer. As we close, I'd like to highlight that an entity recognizes an asset from costs incurred to fulfill a contract with customers only after meeting specific criteria. Aero Academy training dives deeper into these conditions, providing practical insights and case studies to enhance your understanding. For continued learning and to stay connected, visit our website for detailed resources and upcoming sessions. Subscribe to our YouTube channel for regular content updates and join the Aero community to engage with peers and share knowledge. Thank you for tuning in, and we look forward to supporting your learning journey.